Most traders lose money, not because they can't read charts, but because they have no idea which liquidity level the market is hunting, or if that breakout is real or just another trap. Today, we're decoding one of the most misunderstood forces in trading: the liquidity in the market. In just 5 simple steps, I will show you how smart money leaves behind a trail, and how you can follow it to predict trend reversals, sniper entries, and high-probability setups with ruthless precision. By the end of this video, you won't just understand liquidity, you'll know how to trade like the institutions. And hey, if you happen to find value along the way, drop a like, subscribe, and turn on the notification bell to get notified when we upload a new video. It really helps the channel grow. Let's dive into step 1. In this video, I've simplified everything you need to know about trading liquidity. So let's jump right in with step 1, which is understanding the different forms of liquidity. Now, liquidity are areas on the chart where there's a buildup of unfilled orders or clusters of stop losses, and these crucial zones come in 2 powerful forms. When most traders mention liquidity, they're usually talking about what's called external range liquidity, often found at previous swing highs or lows. These levels act like pressure points, where price either breaks through to continue its trend or sharply reverses. This leads to what's known as liquidity runs or liquidity sweeps, both of which we'll break down later in the video. The second form is internal range liquidity, more commonly recognized as fair value gaps. Think of these as fuel tanks for the price that's used to power moves toward those key highs and lows. Understanding how price behaves around both types of liquidity helps us anticipate its next direction with far more clarity. Now for the next step, which is the second step, we have the order flow. This is where things get exciting. Order flow helps us identify which liquidity level the market is likely to target. First, we need to spot whether the price is pushing up through buy-side or down through sell-side liquidity. It might seem complex at first, but we can break it down using just 2 core ideas: break of structure and change of character. Now, here's how it works. When a new swing forms, liquidity builds at both the high and low. The high becomes buy-side liquidity and the low becomes sell-side. Now, if price breaks through the buy-side, it means the trend is bullish. And that's what defines our break of structure, a level that must be broken for the trend to keep going up. But what if price breaks the opposite side? That's where change of character comes in. If price pushes below the low instead, that signals the bullish flow might be shifting bearish. In this case, the sell side becomes the new break of structure, and the high turns into the change of character level, a potential pivot point or level. Now let's look at an example. Imagine that the price pushes through the buy-side liquidity, forming a bullish break of structure. That tells us the trend is intact. From here, new swing points will form, giving us fresh liquidity zones to track. As long as price keeps breaking those highs, the trend is alive, but moving in the opposite direction. Say the price breaks a sell-side liquidity level instead. That's a bearish order flow. Sellers are in control, and their next target is the next lower low. If price then reverses and breaks a swing high, we get a change of character. It's like the market whispering that a trend shift may be on the horizon. To sum that up, break of structure confirms that the trend is continuing, while change of character or market structure shift indicates that the price might be reversing. And as you guys already know, the golden rule is to always trade with the direction of order flow and never against it. But that raises an important question. How do we know when that flow actually changes? Now picture a strong uptrend. The price keeps making higher highs until it hits resistance. This time though, instead of a higher low, we get a lower low. That's our first red flag, a potential change of character. The uptrend might be losing steam. Now this lower low becomes the break of structure level for a possible downtrend. But don't jump the gun. It might just be a liquidity sweep, a quick fake out. And then we wait to see. If the price pushes past the low, confirming a new bearish swing, then we know the reversal is real. Now let's build on what we've covered already. So we are going to dive into how external and internal range liquidity works together, So, in a bullish trend, the price breaks through a swing high. External range liquidity. Great. But to push higher, it needs a launch pad. This comes from a fair value gap inside the previous leg, known as internal range liquidity. This internal range liquidity becomes the fuel. Price pulls back into it, finds support, and blasts through the next external liquidity. And this process repeats. Each bullish leg leaves behind another internal range liquidity, powering the next move. This will result in higher highs and higher confidence. For a bearish moves, it's the same idea but in reverse. The price breaks a swing low, then pulls back into a bearish fair value gap. That internal range liquidity powers the next leg down, forming lower lows. So internal range liquidity fuels the trend, and external range liquidity marks the targets. Watch how these two interact, because that's how market structure unfolds in real time. But here's the kicker. When internal range liquidity no longer holds, it often signals price is aiming for the change of character level. If that gets hit, a full reversal may be on the table. So always keep an eye on how the internal range liquidity responds when price gets near. Now, for the next big step, liquidity runs versus liquidity sweeps. Now, before we move on to the rest of the video, let's check out the Bitunix crypto exchange. One of the world's most advanced crypto exchanges when it comes to crypto futures trading. They offer the best and the lowest maker and taker fees. You can see all my wins and losses since I started trading with this exchange. If you want to follow my trades, just sign up with this crypto exchange using the link in the description below. And if you want to get in early on any crypto asset, just sign up and start using this Bitunix exchange because they are constantly listing the latest and most verified crypto assets or tokens that are set to explode in this bull run. They offer high standard security and even a huge trading bonus for new users. So use the link in the description to sign up and start using one of the best crypto exchanges, the Bitunix crypto exchange. Now, let's move back to the video. What happens when price hits external range liquidity? It can either break through and keep running, or it can reverse very hard. The key is learning how to spot which scenario is playing out. Now, let's take a swing high. Then the price breaks it. That's the first step. But for it to be a confirmed liquidity run, we want to see a bullish candle create a fair value gap during or right after that breakout. That FVG shows buyers are serious, and it will become support for the next leg up. If that FVG formed before the breakout, though, don't count on it. That's old information. We need fresh internal range liquidity created at or above the breakout. Without that, the continuation lacks strength, and the breakout might be a trap. Now, the same principle applies to sell-side liquidity runs. Look for bearish FVGs forming at or below the breakout, and this will tell us that sellers are still in control, and the downtrend is set to continue. It's all about timing and location. Now, let's flip the chart. Say price approaches a swing high, but fails to close above it. Buyers show weakness. That's your classic fakeout, a liquidity sweep in action. You should expect a reversal and also start looking for short opportunities. Even if the price closes above, a sweep might still happen if the fair value gap is left behind underneath. If this FVG gets disrespected, it will be your first sign that order flow is shifting. But you won't enter a short trade just yet. We need a confirmation. So you will watch out for the price to push below the last swing low. That will create a change of character. And a bearish FVG forming after? That's your break of structure. Now it's official. The market has flipped to bearish order flow. The key lesson here is this. Don't trade just because price hits a liquidity level. That's reactionary. Instead, focus on the market structure forming around it. When the structure confirms the direction, that's when you will strike. And that brings us to our final step. Go ahead and join our Telegram channel and get access to high-quality, expert-curated trade signals every single week. But that's just the beginning. For those who want even more, our VIP signal channel delivers the most premium signals with even higher accuracy and more frequent trade opportunities. Don't settle for average trades. Join a community that wins consistently, so click on the link in the description below to join now and start capitalizing on the market like a pro. If you found value in this breakdown, do me a favor. Hit that like button and subscribe to the channel. Your support helps us to keep sharing these advanced trading insights on YouTube. Still have questions? Drop them in the comments and I'll personally help you out. And stay tuned, I've got another powerful concept coming up in the next video to take your trading even further. Until then, trade smart, stay disciplined, and keep learning.